Well, good morning, Daily Hunt listeners. Ethan here, always on the lookout for that next big wave. And what a day we've got. Our AI insights are buzzing, flagging a good number of potential movers, especially in the tech and energy sectors. The sentiment out there, I'd say, is cautiously optimistic, leaning towards promising, especially around the AI supercycle narrative.
And Brooke here, ready to bring those numbers into focus, Ethan. While the buzz is certainly there, our data also shows some serious underlying risks, particularly with stretched valuations and high debt levels. We'll be separating the signal from the noise today for sure, on this Wednesday, February 25th, 2026.
All right, let's jump right into Alphabet. That's Google. The AI chatter around them, it's all about their intelligence factories. Users are very bullish, seeing massive underpriced demand for AI compute. Plus, their revenue growth and net profit margins are really strong, and we're seeing significant insider buying. It was a buy for us most recently on February 21st.
Ethan, while that bullish narrative for GOOG is strong and those insider buys are a good sign, we can't ignore the current PE ratio of 28.74. And we've seen some warnings, like Michael Burry's, about companies potentially using sinister accounting to hide AI costs. Their price is also near its 52-week high, so the upside might be tighter in the short term.
Fair points, Brooke, but the underlying strength is hard to argue with. For Google, we're sticking with a buy. Next up, another tech giant, Amazon. Amazon is also being flagged as a major intelligence factory owner, really well positioned in this AI supercycle. The conviction from users is high, and the company is making a huge AI bet, with positive net insider buying over the last 6 months. They were a buy for us on February 18th.
Yes, but Amazon's PE is also around 29, and their stock saw an 11% drop recently after their AI spending announcement. While the net insider activity is positive, there was still some insider selling mixed in. Investors need to be aware of that volatility and that debt-to-equity ratio of 43.435.
Absolutely, but the long-term play, Brooke, with their AWS dominance and massive AI investments is compelling. For Amazon, we're saying buy. Now let's talk about AMD. There's a lot of excitement around their recent mega chip supply deal with Meta. Users are celebrating significant personal gains, and the general sentiment is that these red team rockets are driving substantial growth, with excellent revenue growth at 34%. We've had mixed ratings, but our last was a speculative gamble on February 4th.
Ethan, that Meta deal for AMD comes with a hefty caveat. Meta can purchase up to 10% of AMD shares, which many users view as significant dilution for existing shareholders. The PE is still a very high 81.93, with a concerning debt-to-equity ratio of over 6, plus there's been net insider selling recently. This stock has a beta of nearly 2, indicating extreme volatility, so, buyer beware.
It's a growth story, Brooke, and the revenue opportunity is massive, but I hear your concerns. For AMD, we're classifying it as a cautious buy. Moving on to Meta. While some social media discussions hinted at Meta being quite behind in the AI race, the company's recent actions, like those massive AMD chip deals and an impressive 18% net insider buying, tell a different story. Their financials show strong revenue growth and net profit margins. Our last rating was a buy on February 6th.
I do like seeing those insider purchases, Ethan, but we also saw significant user skepticism, particularly around the potential for Meta to back CRWV's massive $8.5 billion loan, which could expose Meta to substantial financial risk. These things can impact future earnings.
True, but the strategic AI investments and internal confidence, I think, outweigh that specific risk. For Meta, it's a buy. Let's turn to DHT. DHT Holdings. This one's been buzzing with users cashing in on rising tanker rates, with some reports of record highs. We're seeing an incredibly attractive 8.77% dividend yield, and the company is securing long-term charters at higher rates. This is a new one for our podcast, never rated before.
While that dividend yield is certainly appealing, Ethan, and the market conditions are favorable, DHT does have a relatively high debt-to-equity ratio of over 38. And while the stock is near its 52-week high, new investors should understand the geopolitical risks associated with profiting from war stuff, as some users put it.
Solid points on risk, but the fundamentals look strong for income and growth. For DHT, we're giving it a buy. Now to MU, Micron Technology. Users are reporting huge gains, calling it the memory king, especially with its strong position in AI memory. We're seeing excellent revenue growth at nearly 57% and significant insider buying of over 17% net shares purchased. We rated it a buy on February 18th.
Ethan, despite those impressive gains, a lot of users are advising to take profits. The PE ratio is still quite high at nearly 40, and there's a clear sentiment that much of the optimism is already priced in. Any small snag in their upcoming earnings, could lead to a sharp correction for such a high beta stock.
That's the challenge with growth, isn't it? For MU, given the strong future potential, but also those high expectations, we're putting it down as a cautious buy. Finally, let's look at IOVA, IOVA Biotherapeutics. This is a biotech play with tremendous user optimism. We're talking strong Q4 earnings, significant growth prospects for their product AMZN, and the big one, strong short squeeze potential with over 31% short interest. Plus, there's been massive insider buying with no sales in the last 6 months. We had it as a speculative gamble on December 2nd.
Ethan, this is a very high-risk, high-reward situation. While the short squeeze potential is exciting, the company is still deeply unprofitable, with a net profit margin of almost negative 160% and negative EPS. The debt-to-equity ratio is high, over 7, and, biotech is notoriously volatile.
Agreed on the risk, Brooke, but the upside potential, especially with those clinical catalysts and insider confidence, is why people are eyeing it. For IOVA, we're classifying it as a speculative buy. And then we have CRWV, CRWV. We saw some initial bullish takes on their token factory potential and strong revenue growth.
Ethan, that optimism quickly faded under the weight of the numbers. CRWV has an incredibly high debt-to-equity ratio, over 485, and is currently unprofitable. Users are even calling them debt-weave. We also saw net insider selling. Given the funding strains and lawsuits, it's a classic high-risk scenario. Our previous rating was stay away, repeatedly, most recently on December 20th. I agree with your assessment on the risk there, Brooke. For CRWV, it's a definite stay away for now. All right, that was a whirlwind. Let's round up today's top candidates for your own deeper research. Investigate as buy. Alphabet Inc. Amazon.com Inc. DHT Holdings Inc. Investigate as cautious buy. Advanced Micro Devices Inc. Micron Technology Inc. Meta Platforms Inc. Investigate as speculative gamble. CRWV Inc. And that wraps up another episode of the Daily Hunt for Multibaggers.
This podcast is for informational and entertainment purposes only. The content is generated by artificial intelligence and does not constitute financial advice. Listeners should conduct their own research or consult a licensed financial advisor before making investment decisions. We are not responsible for any losses incurred. The market is a wild place, and knowledge is your best asset. Thanks for joining us. We'll catch you next time.